On August 15, 1971, a man stood in front of a television camera and quietly ended the era when money meant something you could hold. Richard Nixon announced that the United States would no longer exchange dollars for gold, and in that instant, every dollar bill in every wallet on earth became, technically, worth nothing but the promise printed on it. No metal backing it. No vault of bullion guaranteeing its weight in value. Just paper, ink, and collective agreement. And here's the strange part, nothing collapsed. The system kept running. You're still using that same kind of money right now, today, to buy coffee, pay rent, and save for a house, and you've probably never once questioned why a piece of cotton linen paper, or a number on a screen, is worth anything at all. So that's the big question this is really about. Not just what is money, but why do any of the financial systems you rely on every single day actually work? Why does a bank get to lend out more money than it has sitting in its vault? Why does your credit score, a 3-digit number invented by two mathematicians in a strip mall office in the 1950s, decide whether you get a mortgage? Why did a coffee shop in London basically invent the insurance industry? These aren't abstract economics class questions. They are the quiet machinery running underneath your entire financial life, and once you see how they actually work, you can't unsee it. It gets weird. It gets uncomfortably human. And by the end, you'll understand why nearly every financial system humans have ever built runs on the exact same trick, dressed up in different costumes. Right now, today, the baseline assumption almost everyone walks around with is that money is money. It's real, it's stable, it's backed by something solid, and the institutions handling it, banks, stock exchanges, credit bureaus, are neutral, technical, almost mechanical in how they operate. You assume your bank actually has your money sitting there. You assume a stock's price reflects some real, calculable value. You assume interest is just a fee for borrowing, nothing more. Almost none of that baseline is quite true, and the deeper you go, the more you realize the entire system is held together by trust, timing, and a handful of very specific historical accidents. Let's take those apart one at a time. Start with the banks themselves, because this is the one that unsettles people the most once they actually understand it. If you walk into your bank and deposit $1,000, the bank is legally allowed to lend out the vast majority of that money to someone else, keeping only a small fraction on hand. This is called fractional reserve banking, and it means that at any given moment, your bank does not have your money. It has a claim to create it, backed by loans, interest payments, and the assumption that not everyone will ask for their cash back on the same day. Here's the thing, this isn't a scandal or a loophole, it's the entire foundation of modern banking, formalized in the United States through the Federal Reserve Act of 1913. Think of it like a swimming pool with 100 people in it, but the pool was only built to comfortably hold 30. It works fine, every single day, until the moment everyone tries to get in the water at once. That's exactly what happened in 1930 and 1931, when over 9,000 American banks failed as depositors, panicking, rushed to pull out cash the banks simply did not physically have. Their mechanism is elegant and terrifying in the same breath. Banks create money, in a very real sense, every time they issue a loan, because that loan becomes someone else's deposit, which becomes the basis for another loan. Sound familiar? Because this is still exactly how your bank operates right now, this afternoon, with your paycheck sitting in it. Now push that same idea of trust forward 200 years earlier, to compound interest, and you get one of the strangest financial experiments in American history. When Benjamin Franklin died in 1790, he left a rather odd bequest in his will, £2,000, split between the cities of Boston and Philadelphia, with extremely specific instructions. The money was to be lent out to young tradesmen at low interest, and it was not to be touched, fully and finally, for 200 years. Franklin had done the math himself, understanding something most people even today don't intuitively grasp, that money left alone to compound doesn't grow in a straight line, it curves upward, slowly at first, then dramatically. By 1990, 2 centuries later, Franklin's original gift, thanks to compounding, had grown into millions of dollars across both cities. Here's where it gets interesting. Franklin wasn't a trained economist. He was a printer who understood one very simple mechanism deeply. interest earning interest, given enough time, behaves less like arithmetic and more like something biological, almost alive. That's the exact same force sitting quietly inside your retirement account right now, and it's why financial advisors will tell you, again and again, that starting 10 years earlier matters more than almost any other decision you'll ever make with your money. But interest only means anything if there's a marketplace to actually put money to work, and for that, you have to go back to Amsterdam in 1602. The Dutch East India Company, trying to fund enormously risky and expensive voyages to Asia, did something no one had systematically done before. It sold shares of ownership to the public, and then let people trade those shares with each other on the open street outside a building on the Damrak. This was the birth of the modern stock exchange. Investors weren't lending the company money expecting it back with interest, they were buying a sliver of ownership, betting that the value of that sliver would rise as the company succeeded. Here's the mechanism that's easy to miss. A stock's price isn't really a measurement of what a company is worth today, it's a constantly shifting bet on what thousands of strangers believe it will be worth tomorrow. That's why a company can lose money every single year and still have its stock price soar, the way Amazon did for most of the 1990s and early 2000s. You're not buying today's value. You're buying a story about the future, priced in real time by the collective guesswork of millions of people. Now flip the entire concept upside down, because if money can grow through trust, it can also collapse through the loss of it, and nowhere is that clearer than in Germany in 1923. At the start of that year, $1 American was worth roughly 18,000 German marks. By November, that same dollar was worth 4.2 trillion marks. Germans were famously photographed pushing wheelbarrows full of cash just to buy a loaf of bread, and some workers were paid twice a day because prices would rise before lunch was even over. Here's the mechanism: stripped of the chaos, the German government, crushed by war reparations from the Treaty of Versailles, simply printed more and more money to cover its debts. But money's value depends entirely on scarcity and trust, the same trust that keeps your bank account functioning right now. Flood the system with unlimited paper, and each individual bill represents a shrinking fraction of real value. It's the same reason a common baseball card is worth nothing while a rare one is worth thousands. Scarcity is doing almost all of the work. Weimar Germany didn't lose its wealth. It lost the story that made its currency mean anything at all. That same fragile idea, trust as currency, is exactly what makes insurance possible, and you can trace it back to a coffee shop. In 1688, a man named Edward Lloyd ran a coffee house near the Thames in London, popular with sailors, ship captains, and merchants swapping news about which vessels were arriving, which were overdue, and which had likely sunk. Wealthy patrons began doing something clever, agreeing to personally cover a portion of a ship's potential loss in exchange for a fee paid upfront, spreading the risk of any single catastrophic loss across dozens of individuals. That coffee house eventually became Lloyd's of London, still one of the largest insurance markets on earth. Here's the mechanism, and it's beautifully simple. Insurance doesn't prevent bad things from happening, it just makes the cost of bad things predictable by spreading it across thousands of people who probably won't experience it at the same time. You've got the same principle running your car insurance and your health insurance right now. Most people paying in every month will never file the claim that justifies what they paid, and that's not a flaw in the system, that's the entire system working exactly as designed. All of this brings us to the number that quietly follows you around every time you apply for a credit card, a car loan, or a mortgage: your credit score. This wasn't handed down by any government. It was invented by two men, engineer Bill Fair and mathematician Earl Isaac, who founded their company, Fair, Isaac and Corporation, FICO, in 1956, working initially out of a converted garage. Their pitch to lenders was radical for its time. Instead of a loan officer deciding, based on gut feeling and personal bias, whether you seem trustworthy, a mathematical model could predict your likelihood of repayment using your actual financial behavior. It took decades to catch on, but by the late 1980s the FICO score had become the industry standard, and today it decides, almost invisibly, the interest rate you'll pay on nearly everything you finance for the rest of your life. Here's what nobody tells you: your credit score isn't a measurement of your character or your worth as a person, it's a probability estimate, built entirely on patterns, of how you're likely to behave with borrowed money based on how you've behaved with it before. It's less a judgment and more a very sophisticated, very cold bet. And that brings you to the lever that sits above almost everything you've just heard: interest rates set by central banks. In 1979, the United States was drowning in inflation, prices rising at nearly 13% a year. Paul Volcker, newly appointed head of the Federal Reserve, made an aggressive and deeply unpopular decision. He pushed interest rates up to nearly 20%, deliberately making borrowing painfully expensive to choke off inflation, even knowing it would trigger a recession. It worked, brutally. Unemployment spiked, but inflation, over a few grinding years, came back under control. Here's the mechanism underneath every rate hike you hear about on the news today: raise the cost of borrowing, and people and businesses slow their spending, cooling an overheated economy. Lower it, and you encourage borrowing and spending to heat a sluggish one. It's the exact same lever, and Volcker's 20%, compared to the near-zero rates of the 2010s, shows just how far that dial can swing depending on what the economy needs. So look at everything stacked up here. You've got banks lending out money they don't actually hold. You've got compound interest quietly turning small sums into fortunes given enough patient time. You've got stock markets pricing not what a company is, but what people believe it will become. You've got hyperinflation showing what happens the instant that belief collapses. You've got insurance turning catastrophe into a predictable monthly fee by spreading risk across strangers. You've got a credit score reducing your entire financial reputation to 3 digits built from pattern recognition. And you've got central banks pulling a single lever, interest rates, to speed up or slow down the whole machine at once. Here's the unifying thread running through every single one of those examples: none of it is actually about money. It's about trust, engineered into a system precise enough to function at the scale of millions of strangers who will never meet each other. A bank works because you trust it'll be there tomorrow. A stock works because buyers trust the story of future growth. A currency works because an entire nation agrees, silently and constantly, to keep believing in it. Insurance works because strangers trust that spreading risk protects everyone better than facing it alone. Every one of these systems is a different technology built to solve the exact same ancient problem: how do you get people who don't know each other, will never know each other, to cooperate, take risks together, and hand each other things of value, based on nothing more solid than a shared agreement to believe? Which brings you back to that paper in your wallet, or more likely, the number glowing on your banking app right now. It isn't backed by gold anymore, and it never really needs to be, because it was never the metal that made it work. It was always the story, the collective, quiet, everyday decision by millions of strangers to keep believing the number means something. That belief built compound interest that turned Franklin's small gift into millions. It built stock markets pricing the future before it happens. It built insurance out of a coffee shop conversation, and a credit score out of a mathematician's garage. It's fragile enough to collapse into a wheelbarrow of worthless bills in a single terrible year, and durable enough to have quietly run the entire modern world for over 3 centuries. The next time you tap your card without a second thought, remember what you're actually trusting isn't the plastic, or even the bank behind it. It's an idea, held up by millions of people you will never meet, all agreeing, together, to keep believing.